Get Rich Education is brought to you by Norada Real Estate and GREturnkey.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education, episode 148. Hi, I'm your host, Keith Weinhold, back to help you build your wealth. And we've got a great guest later in the show today. Do the markets feel frothy to you? Real estate prices are up. The Dow recently cracked 22,000 points. Many tech companies have valuations in the hundreds of billions of dollars, yet they don't even make a profit. Valuations of major pro sports franchises are through the roof, with many of them, like the New York Yankees, now valued at more than $3 billion. And outside of the numbers, why don't you just look at some of the softer signals in the economy? What do you see every day yourself? Are you finding it difficult to get reservations at B-plus restaurants? Marginal talent is demanding a lot of money. You know, it feels like you could wake up tomorrow and a 20 to 30% correction could take place, and you might say to yourself, well, of course it did. It was time that we have one. So, well, what do you do about that yourself? How do you position yourself? Well, chances are you've already hedged yourself because you buy real estate, principally for income production and not for asset price appreciation. And what's happened to real estate prices recently? Well, let's take a look at this. The median sales price of existing homes sold in the USA in June of this year, which is the latest month we've got data for here, and I'm just going to round these figures off, okay? That price was $264,000, and that is an all-time record. However, the median sales price of existing homes sold in July of 2006, over 11 years ago, right around the peak, and this is where we hit the high, okay, that was $230,000, and that's equal to $278K in today's dollars. So that $278K from over 11 years ago, that is still the all-time high on an inflation-adjusted basis, and that's from the National Association of Realtors. So inflation-adjusted, it's $264K now, and it was $278K back then in 2006. And as you know, inflation is understated, so it very well could be $264K now and $300K back then. So really the message, the bottom line with this is that real estate valuations in real dollars are still 5 to 10% below their 2006 peak. Now, let's look at what the rise in real estate values, basically they've been rising since 2010. Let's look at what they've done to underwater homeowners, okay? Homeowners that have mortgage debt that exceeds the value of their homes. Back in 2010, when underwater homeowners peaked, 15 million homeowners were underwater. Today, it's less than 2 million. Now, a couple things with valuations. As a Get Rich Education listener, you're likely buying in markets in the Midwest and South. That's what I like to call the stable metro markets, where even following the housing crash 10 years ago, you didn't have these aggregate 20 or 30% losses in valuation in a lot of these stable markets. In fact, asset price crashes, that's just something that's really not even as relevant for you as they are for other investors because you're purchasing based on income production. In fact, you might actually want real estate prices to drop because that is going to make people lose faith in wanting to buy their own home, and it'll drive up demand to rent your property from you and therefore drive up your income. I've invested through such a cycle. So as we look at those markets in the Midwest and South, which are those that I like to call volatile markets, and those volatile markets like Manhattan and Miami and San Francisco, they're the ones most susceptible to price crashes. And those volatile coastal markets, that's exactly where you need price appreciation if you're going to make out there on those deals, because on a cash-on-cash return basis, those deals are lousy. So within those stable markets, you have to look at what type of housing types make sense. And, there are always deals out there, but today it's awfully hard to find apartment deals. It's also hard to find mobile home park deals and a lot of other types. But although the inventory of single-family income properties is thin, when I can get one, I like to look at single families today more so than apartments, even though I own both types. In fact, just the other day, it marked 15 years for me since I began investing in real estate by buying an owner-occupied fourplex building for $295,000 in Midtown Anchorage, Alaska. That date that I closed was August 8th, 2002. Yeah, 15 years now. Single-family income properties have a lot of advantages over apartments that some people just really aren't aware of. And this is something that I wrote about for the Rich Dad Advisors recently. Apartments garner attention as wealth creators, and as well they should, because their economies of scale make apartments look fantastic when you analyze a P&L, a profit and loss financial projection spreadsheet. But these P&Ls are mere projections. They're trying to forecast the future. When an investor holds a property for a number of years and then sells it, rarely does anyone perform forensics, an actual backward-looking evaluation on their rate of return. Few people calculate what actually happened after factoring in appreciation and rent income and principal paydown and taxes and then all of their expenses. This just happens in society a lot. I think it's just the way people think. This happens a lot with the weather also, okay? It's easy to find a weather forecast for a given area. They even put these forecasts out 15 days in advance anymore, but it's harder to find out what actually happened. Did it rain in Sacramento 2 days ago? It can be hard to find that information. And we actually get lessons when we learn about what actually happened to our properties as investors, because we can apply that knowledge to our future decision-making and be profiteers. Interestingly, when I've run forensics, backward-looking data at what actually happened for buy and hold income property, I often find that my single-family residences have performed better than small to medium-sized apartment buildings. There's a reason that a few years ago, Warren Buffett told CNBC that he would buy up a couple 100,000 single-family homes if it were practical to do so. Now, apartment buildings do have some certain advantages over single families, and we're just going to be talking in generalities here, but let's look at why investing in single-family income property can often be more profitable for you than investing in apartments. It really starts with tenant quality. This is where your income comes from. Single families attract a better quality of tenant than apartments. Properties also tend to appreciate better over time. Your single-family property tends to be in a better neighborhood, and you're also more likely to be in a better school district. So when we talk about tenants and tenant quality, let's look at retention. Tenants tend to stay in single-family income properties longer because it feels like their own rather than being in a communal apartment. So the more frequent vacancy and turnover and make-ready expenses, that's an underestimated killer on apartment investor profits. And those better neighborhoods and school districts, that's something that aids in that tenant retention in single families. In apartment buildings, you have common areas to clean and maintain. Apartments have hallways, stairs. They usually have laundry rooms or maybe a storage and vending area. Well, a custodian needs to clean all those places, and that's just another overlooked profit drag that apartment investors miss in their profit and loss. That's one that's commonly missed. In single-family income properties, tenants often pay for all of the utilities, and they even care for the lawn. The larger the apartment building is, the more likely it is that you're going to be the one stuck with more utility costs. Divisibility is something I like to talk about. What if you've got a property out there that's underperforming? Not every property you purchase is going to perform as expected. That's just reality. Well, say you have 10 single-family income properties. Well, you can just sell off the one or the two that are not performing. But with a 10-unit apartment building, you've got to keep all of the units or sell all of the units so it's not divisible. This is kind of an ugly one, but think about pestilence, okay? If one tenant attracts a cockroach or a bedbug infestation, and really the latter of which are becoming more prevalent, well then this quickly becomes a diffuse condition and a real problem across an entire apartment building. I recently had a tenant bring bedbugs into an apartment building of mine. Tenants fled. Extermination fees alone were in the 5 figures, partly because it was so difficult to kind of get all the families to cooperate at the same time with these extermination preparations and protocols that they needed to make. Well, in a single family, pests are more easily controlled. You only need to get one family to cooperate with extermination, and the problem also cannot possibly spread to other units. And it's kind of the same way with fire. With fire, even if you're adequately insured, apartment fires affect multiple units and families, and with single-family income properties, this risk is reduced. Then there's, we're really getting kind of nasty here, but, God forbid, what if you get a drug dealer in one of your units? Well, in an apartment building, one drug-dealing tenant, that can disrupt multiple families. And again, apartments attract lower-quality tenants. When it comes to your financing, income single-family properties have both lower mortgage interest rates and lower down payment requirements than apartments do. A husband and wife can get 10 single-family loans, each 20 total, and you can get those at the best rates and terms through Fannie Mae, Freddie Mac with 20% down payments. And there are other financing options once those 20 loans are exhausted. And apartments rarely, if ever, have 30-year fixed-rate terms like single families typically do. Think about your vacancy rate. It is true that if your single family property is vacant and you've just got one, well, then your vacancy rate is 100% and you don't have any income. But say you bought a small apartment building, say you even bought a fourplex, say you have one vacancy there, well, then your vacancy rate's only 25%. But you know what? The same is true if you own 4 single families and one is vacant, your vacancy rate is still just 25%. Think about management. If you hire professional management, which I hope you do sooner than later, well, your manager would likely rather deal with single-family dwellers. Single-family is a demographic that you would likely rather handle too if you do start off self-managing. Now, you do tend to pay a higher management fee for single-family homes rather than apartments, but I contend that it's worth it because those properties typically tend to be spread all over the place. Think about supply and demand. Today, contractors are building a lot of new apartments, but they rarely build these low-cost single-family homes that make the best rentals. Rental single-family demand vastly exceeds supply. That's not going to change anytime soon. Another overlooked criterion is that of market risk. Market risk. You've got to keep your rentals filled with rent-paying tenants that have jobs. Do you think you'll be able to buy 10 rental units in the near future? Well, your 10-unit apartment building, that can only be in one location. That leaves you exposed to one metro market's economic fortunes and just one neighborhood's fortunes or losses. Well, if you got 10 single-family properties instead, you could have 4 in Birmingham, 3 in Dallas, and 3 in Jacksonville. And of course, we tell you where to find the properties where the numbers work in the right markets at greturnkey.com. And those markets at greturnkey.com, they do change over time as markets change. For example, Phoenix, Arizona used to make sense for these, and it no longer does. And finally, when it comes to single-family advantages over apartment buildings, think about your exit strategy years down the road when it's time to sell your income property, hopefully after years of handsome profits for you, when you're ready to cash out refi or 1031 exchange since you're exiting. There is going to be a much greater buyer pool for your single family than for your apartment building because more buyers can afford the lower price of the single family. Unlike apartments, you even have access to a pool of buyers that might want to occupy the single-family residence itself. You don't know what kind of cycle we're going to be in when it's time for you to sell, so you've hedged yourself that way with exit strategy. So those are some of really the little discussed advantages of single-family income property over small apartment buildings, and there just aren't very many people that take the time to do those backward-looking analyses and see what actually happened. Well, we've got a great guest today. It's the host of the New Orleans Investment Conference, Brien Lundin. That's an upcoming event that I'll be attending here. It's an event that was launched in the 1970s, and it's been held every year ever since. And it was born really out of Americans' ability to possess gold and silver again, because previously it was illegal to possess that. It was actually illegal to possess gold and silver until just a few decades ago, or gold anyway. The New Orleans Investment Conference has since branched out into all types of real asset investing. In fact, this year, Robert Kiyosaki will be speaking there, as are the real estate guys, Robert Helms and Russell Gray, and quite a few other speakers, which I'm sure Brien will tell you about. Now, when it comes to gold and silver investing, I'm not a huge gold guy, not a gold bug at all. In fact, I've told you on earlier episodes that I hold about 1.5% of my net worth in gold and silver, and that's all held in physical bullion, although there are other ways for you to hold it other than just physically. Well, why do I have any precious metal at all? It kind of acts as money insurance. It's a store of value, and at times of economic uncertainty or even calamity, it has more value. It's also an international investment, much like your home or car insurance. Kind of just like with gold as money insurance, it's good to have a little, but I hope I don't have to use it, okay? Just like other types of insurance. Well, why don't I have more than 1.5%? Well, principally because metals don't produce cash flow. Unlike real estate, I have never received one monthly payment from gold or silver or platinum. In fact, there was this one time where I was at an event and I was speaking with a metals advocate in one of the hallways, and just out of interest, I asked him what he thought the right precious metals allocation was for me after I refreshed him on my situation. And you know what he told me? He told me that a 30% position seemed about right for me. That was his opinion. And I basically replied to that person, well, in order for me to go from a 1.5% position up to a 30% position, I would have to sell so many income-producing assets to make the reallocation that my income would drop to the point where my lifestyle would be diminished. And I think that gave that person some pause when I put it that way, okay? As far as using metals as an inflation hedge, which some people do, and it is generally an effective protection that way because, just look, 50 years ago, an ounce of gold was worth $250, and that would buy you a fine man's suit. Today, gold is worth between $1,200 and $1,300, and that would still buy you a fine man's suit, the same one. I feel like I've already got my inflation hedge covered pretty well with the long-term fixed interest rate debt that I have tied to income-producing real estate. Now, as a real estate investor, I've discussed how you do want to hold on to some reserves. About 3 to 5% of your total real estate owned is a good percentage for you. So if you owned $1 million worth of real estate, you might want to have as much as $50,000 in liquid reserves. And you might do very well to keep that bottom half of your 50K reserves in gold and silver in that example. Metals are highly liquid, but you got to remember that buying and selling metals basically incur a transaction cost to you. You might even call it like a closing cost of a few percent due to these spot price differentials. You have to buy it for a few percent more than spot price and typically sell it back for spot price or a little bit less. So that's why it might be the bottom half of your reserve pot, meaning that it's the last thing you would liquidate in an emergency. Now, the United States and other nations certainly have their share of problems and debts, and that creates a great degree of uncertainty for some people. But people have been predicting the end of the world since the beginning of the world, and the U.S. is better off than most places. The dollar might not be the best currency, but as the world's reserve currency, you might just call the dollar one of the world's least worst currencies. And precious metals, that can give you a way to get really easy diversification out of the dollar and out of every other world currency for that matter. All these currencies keep getting debased. Metals are a real asset that is international, and you can accomplish some of that international diversification by owning a real asset by paying as little as just $20 for a 1-ounce silver bar or $15K for a 10-ounce gold bar. So I'm not so much of a big gold guy, but I do have some. And as a real estate investor, I like to listen to what the gold guys and macroeconomists have to say from time to time, because what's happening with gold is sort of a proxy for economic uncertainty and expected inflation, and that affects us all as real estate investors. So I'm going to ask Brien Lundin about why he thinks it's important to invest in gold now of all times when we've got low inflation. You know, globalization, it not only suppresses wages, which helps keep inflation in check, but globalization, it also makes war and war's resultant uncertainty less likely. Okay, for example, if Apple Corporation has a presence in Korea and they have a presence over in Vietnam and they have a presence in Germany today, well, doesn't that make it less likely that the United States would bomb foreign countries when they would effectively be bombing factories of U.S.-based companies? I mean, the internet has connected us all, and we all sort of understand each other better and communicate with each other more, and there's more corporate internationalization than there's ever been. So we're kind of more hedged against the global uncertainty of war, and war is something that often makes metals prices spike. Brien Lundin, host of the upcoming 43rd Annual New Orleans Investment Conference, joins me right after this. Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME.
Are you on track to achieve your financial goals? Income-producing real estate is the most historically proven way to accumulate wealth and has created more financial freedom than any other means. Norada Real Estate provides everything you need to invest in the best turnkey cash flow rental properties. Our simple, proven system will help you create real wealth and passive monthly income. Get your free strategy session with our knowledgeable investment counselors at noradarealestate.com. That's NORADA realestate.com.
This is Cashflow Diaries Jay Massey. Do the right thing, then do things right. Listen to Get Rich Education with Keith Weinhold.
Today's guest is one of the brightest minds in the world for precious metals. He's the editor of the Gold Newsletter, which has been around since the 1970s. He's been the editor since 1993. The Gold Newsletter is known as the oldest and most respected precious metals and mining advisory in the world. He also hosts a fantastic event, the annual New Orleans Investment Conference. It's a world-class investing event, which I'm going to be attending once again this year in about 2 months here, where some of the previous speakers have included Margaret Thatcher, President Gerald Ford, Henry Kissinger, and when I attended 3 years ago, former Fed Chairman Alan Greenspan was the keynote speaker at the event. Welcome to Get Rich Education, Brien Lundin.
Glad to be here, Keith. Thank you.
Hey, it's really good to have you. Now, we're talking mostly to real estate investors today, and they're not as familiar with gold, but gold is a real asset, much like real estate is. So just tell us a bit about the role that gold plays in the world today.
Well, that's exactly it. Both real estate and gold are real assets. Now, of course, real estate can produce an income, and gold does not. But they both function as ways to preserve wealth in a time where the currency is being depreciated. In other words, price inflation. And that type of environment, of course, is what we saw during the 1970s. And we saw that gold prices soared to record highs since 2008, since that credit crisis, We've had really an unprecedented level of monetary creation, of debt creation, and credit creation in all the major developing world economies. And what that means is that eventually we're going to see that same kind of currency depreciation. It absolutely has to happen because of all this money that has been created. So like real estate in such an environment, gold provides safety and security and wealth preservation in that kind of an environment. It also has liquidity that real estate doesn't offer. You can sell it 24 hours a day anywhere in the world. So that's another advantage that it has. It really is a very direct proxy, an anti-cyclical proxy. It's the other side of the seesaw, as it were, to government policies that depreciate the currency and create debt.
So if you go ahead and look at the 100 years of what a dollar is worth, you take a look at that diminished purchasing power over the last 100 years. We've had a dollar 100 years ago have about the purchasing power of 3 cents today, really. So we've seen such a diminishment in the dollar. You mentioned quantitative easing. We had 3 quantitative easing cycles starting about 8 years ago, effectively money printing. And, a lot of people predicted that we'd be in a higher inflationary environment than we are now after all that printing, which is something that would be bullish for gold, because as the dollar gets weaker, as more are printed, it takes more of those dollars to buy an ounce of gold. Globalization has been such a tug on inflation. Do you think that's one of the things that's kept the gold price in check? Because the gold price now really isn't any higher than it was 1 year ago, or even 5 years ago for that matter. How much of that do you think is part of the fact that we have pretty tame inflation?
Well, the gold price is considerably up from when we had the 2008 credit crisis. Now, when the Fed started its quantitative easing programs, gold reacted and more than doubled in price. And then since 2011, when the Fed basically announced that at some point they were going to stop this policy, that's when gold peaked and started falling down or dropping. We did bottom in the gold market in December 2015 and have been going up in kind of a stair-step fashion since then. So we are back on the upswing. But your point about why we haven't had price inflation after such tremendous currency creation and debt creation is really a good one. And there are really a couple of reasons for that. One is that we have had inflation, but not in goods, but in financial assets. All of that money that was created has been held back from the economy by the Federal Reserve through a number of different policies, but it has landed on Wall Street. And as a result, we've seen tremendous inflation in financial assets. The stock market, of course, is setting new records every day. What a lot of people don't realize is if you look back to 2008 and look at the growth in the Federal Reserve balance sheet, it has a 97% correlation with the growth in the S&P 500. And that's not a coincidence. That money went into the financial markets, propped up and buoyed up equities and the equity markets. And that's what we're seeing still today. Because of all this money and low interest rates flowing into the financial markets, there was a lot of malinvestment, a lot of oversupply created. And this, in fact, has been deflationary. The Fed and the other world central banks are really pushing on a rope here, trying to create inflation in an environment where there has been such malinvestment and overcapacity and low productivity.
Yeah, it's kind of a tug of war between the printing press and globalization back and forth. It's just really interesting to see how that's going to turn out. As society goes on, one thing I think we could agree on, Brien, is that individuals don't become any more trusting of their government. They might be even less trusting of their government. One place that's potentially resulted is really the rise in cryptocurrencies like Bitcoin and Ethereum, and they've really made a lot of news lately. And I think one reason that people like them is that they are outside of the banking system, and they are currencies that are not nationalized. They don't belong to any one nation's government. Now, gold, that's really not a currency like cryptocurrencies are, but it is a store of value that exists outside of banks and outside of the control of any one nation, and it's done that for thousands of years.
Gold's role is as insurance against the inevitable destruction of currencies by nations. It has happened in every environment even when there were gold standards in other civilizations previously, there was still retail price inflation. Governments would overspend, and therefore they would depreciate the currency by clipping the edges of gold coins or alloying the gold with cheaper metals. So there was always currency depreciation, even when there were gold and silver standards. Today, when there is no attachment between metals and money, or currency rather, it's much easier. In 1971, when Nixon closed the gold window and completely severed the link of convertibility between the dollar and gold, that gave the government free rein to print as much money and to create as much debt as it wanted. Not coincidentally, that's when Gold Newsletter was started as a way to advocate for the return of gold ownership to U.S. citizens. So this newsletter in our conference has been around since then and was created literally to help American citizens invest in gold, create the ability for them to invest in gold, and to teach them how to do so.
Yeah, we think of gold as that store of value and something that people take flight to for safety when there's a lot of uncertainty out there. You know, one interesting thing is that silver is more scarce than gold, which is really surprising to a lot of people. Above ground, there's only a quarter as much silver as there is gold, and silver also gets consumed, just used up in manufacturing, and gold for the most part doesn't. But yet silver today is only about 1/75th the price of gold. So any thoughts on silver versus gold?
Absolutely. I think there are a lot of reasons to buy gold. I think the arguments for investing in gold are irrefutable, and far higher gold prices are inevitable. And if you like gold, if you agree with that thesis, then you need to own silver. Silver moves much more than gold, and for the same reasons. If gold prices are rising, silver prices are going to rise more so. So it gives you leverage to that move. The other side of the coin, literally, is that if gold prices are dropping, silver prices will drop further and faster. But in an environment where the long-term picture argues for higher gold prices, you absolutely need to own silver. It is the poor man's gold and essentially an option on gold prices. So I always recommend silver very highly to anyone getting involved in the precious metals space.
Okay, because you think that's likely going to follow gold. And what are your reasons for thinking that the price of gold is going to go substantially higher in the near future or the intermediate term future?
We're coming off an environment where we've had the lowest interest rates in human history. We've also created, as both as in a nominal amount and as percentages of GDP, the greatest debt loads in history outside of wartime. So we have this mountain of debt. We have this tremendous amounts of currency that have been created since 2008, not only in the U.S., but in Europe and in much of Asia. These debts cannot be managed. They're creating too great of a load on national economies to allow, number one, for interest rates to rise to any normal level. So that's out of the question. And on the other hand, the debt loads, even at low interest rates, cannot be managed unless there are tremendous spending cuts by Washington and the rest of the world, which we know won't happen, that there's tremendous economic growth, which is unlikely. The only answer left is that the currency has to be depreciated. That's always been the fallback solution for civilizations, again, in all of human history. The dollar will have to be depreciated, as well as every other major fiat currency in the world today. If all the currencies are being depreciated, if there is competitive devaluations of currencies throughout the world, there's only really one thing or two things that they can be depreciated against, and that's gold and silver.
Now, the conference that you host, the New Orleans Investment Conference, was basically founded out of the fact that it was illegal for Americans to possess and own gold a few decades ago, just like today it might be illegal to possess heroin or some other illicit drugs. Jim Blanchard helped found the conference out of that. So just tell us about the roots of the New Orleans Investment Conference and just what one can learn at the New Orleans Investment Conference today.
Absolutely. Jim started Gold Newsletter in 1971 on the day that Nixon closed the gold window, the day that it was announced. And he started advocating for the return of the right of gold ownership to American citizens. A lot of people don't realize that FDR made it illegal for Americans to own gold in 1933 and confiscated Americans' gold outside of jewelry or collectible coins. So again, like you say, it was classed the same as heroin or plutonium even. It was illegal for Americans to own. By 1974, Jim and his colleagues had lobbied enough and convinced the government to legalize gold once again. It was actually legalized last day of 1974. To get ready for that, Jim in the spring of 1974 decided to have an investment conference to essentially teach Americans how to invest in the gold market. He had that conference. It was a rousing success. And ever since then, in the fall of every year, we've had the New Orleans Investment Conference. As you said, we've had some of the giants of recent history. Margaret Thatcher, Ayn Rand had her last public appearance at our event. Barry Goldwater, Alan Greenspan. It's just the list goes on and on. The people who come to our stage, that have graced our stage, come there because they're talking to really elite, sophisticated investors who want to learn about what's going on in the greater geopolitical picture, the economy, and various investment sectors.
Yeah, I really learned quite a bit the last time that I was there. Yeah, this year's conference, which is October 25th to 28th, some of your key speakers are Tucker Carlson, Doug Casey, Peter Schiff, and Robert Kiyosaki, someone that's had substantial influence on me and a lot of our listeners as well. What do you think we can expect from the speakers this year?
Well, I'm very excited about having Robert here this year. This is the first time he's spoken, and as you know, he can absolutely mesmerize an audience. And what he has to say about not just wealth creation, but wealth preservation resonates so well with everyone and has changed so many lives. I'm very excited about getting a lot of people whose lives have been changed by Robert to come to our event for the first time, and getting a lot of our attendees who are regularly attended over the decades to be exposed to Robert's wisdom. We also have Charles Krauthammer, Tucker Carlson, as you say, Dennis Gartman, Doug Casey, Peter Schiff. And they're going to repeat the theme that I was just talking about of explaining to investors what the macro picture is, what the big secular trends in the economy and the investing markets mean for their portfolios, for their wealth, and how they can not only protect their wealth from these trends, but also capitalize on them with not only powerful strategies, but specific investments that should really outperform in these kinds of environments.
Well, I plan to be there again this year, and I know some of my listeners have reached out and told me that they're going to be there as well. Brien, Lundin, any final thoughts on gold in 2017 or the New Orleans Investment Conference?
This is precisely the kind of environment that gold is meant for. I really think that we're going to have higher prices going into the end of the year and in the succeeding years. I think we've entered into a new bull market environment for gold, for precious metals, and for mining stocks that kind of leverage these gains. In this kind of environment, the New Orleans Investment Conference is the place to be. It has been for 4 decades, and the record shows that when you have rising gold prices, rising precious metals prices, the New Orleans Conference leads investors to investments that perform far better than anything out there.
And you also do have some real estate exhibitors. So you basically have an exhibit hall in the room, typically across the hallway from where you have the speakers, where you can learn about everything from junior mining companies to investing in hard assets in Central America and commodities like coconuts and timber and so on. So there really are just a world of possibilities. And, you know, I left there 3 years ago with my head so full of investing ideas. I just wanted to take a day off so I could absorb everything, look over my notes, and reconsider some things. So, Brien Lundin, thanks so much for coming on to Get Rich Education.
Great to be with you. Thank you.
Yeah, great job. Thank you, Brien. Consider meeting me and learning a lot at the upcoming New Orleans Investment Conference. You're going to increase your knowledge and you're going to increase your relational capital too. And you know what? Neither one of those two things can be taxed, and the government cannot confiscate either one of those things from you. what you can do is go to getricheducation.com/events, where you can find out about how to register there. That's the page where you can also find out about some of the other events that I'll be attending this year. I'm about to head off to St. Louis, Missouri for a real estate investment tour where I plan on researching and then giving you a report from the field down the road here. Until next week, check out getricheducation.com/events and don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.